All right, well, greetings, everybody, and thanks, Ken, and thanks also, Cy, and again, everybody. Hugh McManus is traveling and won't be able to join us again tonight. He's been quite preoccupied lately, but I think we're in for a pretty good session tonight, very festive. Happy Thanksgiving to all of you out there, and hopefully the 5 out of every 4 of you that went shopping have recovered from the shopping weekend, and sounded like a lot of people are out there shopping. And we're going to go through a fairly ambitious schedule. So again, welcome to all the people that are returning from previous sessions, and a big extra special welcome to those who may be joining us, especially those from all throughout the nation. Special welcome to our local Mid-Michigan folks, but also people from all over the nation that are joining us here tonight. Let's go ahead and get the legal stuff out of the way. As it says there, this is an educational demonstration, and you guys all know this. No investment recommendation of any kind whatsoever is intended. You guys all know that, but we have to make sure we clarify that. Everything that we do here is for illustrative purposes only. We do talk about real companies in real time, and we will share our opinions about 3 of our most favored investments at this particular point in time. Here's a quick look at the agenda for tonight. We'll take a quick look at the scoreboard, and then tonight we actually do have something kind of unique. We're going to actually talk about basically selling Research in Motion, TJX, and Lilly before we get underway. And then Ken, Cy, and I will give our 3 stock presentations that you can see there. And like we say, Hugh is detained and is probably traveling somewhere between Switzerland and Pasadena. And as always, we'll do or as usual, we often do the audience selection based on the 3 stocks that we will present. A couple of them are repeats, but you should know that the audience has been quite successful in their selections over the last year or so. The most successful of any component of our overall results. Just as a reminder, this is what we're here to do. We do take this pretty seriously. We do limit things to mostly core type investments, those up, straight, and parallels. Our goal is to achieve a long-term relative return. Again, that's a benchmark versus the Wilshire 5000 of plus 5%. We'll take a look at that here in a minute. And our accuracy goal is to pick things that go up. And we'd like to see them go up 60 to 70% of the time. We'll jump right in and keep this short and sweet. We're pretty close to our outperformance accuracy. In other words, 55.3% of the stocks we've picked since July 2010 have actually outperformed the market since the time we picked them. That's beginning to approach the levels we want to be at. Over the longer term, we really would like to be up into that 60 to 70% range. We know that they're not all going to work out. And we actually are very specific about how well we want things to work out in general. This is our target. This 5% level that you see here, this dotted line across the top, we would like to outperform the market by 5 percentage points over the long term. And you can see that we went through quite a period of time when we weren't doing so well. And the trend is in the right direction, including over the last month or quarter or so. So we're quite enthusiastic, continue to approach zero, continue to approach positive relative returns. And we look forward to the day when we get there and stay there and get up towards that 5% level. We do think it's possible. This line down here is a tribute to the average investor. The average investor as defined by the 20-year results according to a recent DALBAR, that's D-A-L-B-A-R, survey that showed that the average investor investing in the stock market achieves a return that is 5.3 percentage points less than the total stock market itself. So we'd certainly like to stay way above that. Any questions or comments on that, Ken? Any questions so far?
I'll just make one observation, Mark. You and I have talked some about this, and it's certainly good to see our relative return going in the right direction. But one thing that I have noticed with newer portfolios managed our way, frequently we don't start to outshine the market until there's a significant downturn, which we've not had yet. I experienced that with the tracking portfolio that I use for, or actually that's a model portfolio for the growth stocks column in Better Investing magazine. We were running about market, or maybe a little better or a little behind, up until the last bear market in '08, and that's when it really turned around. And it seems like one of the other portfolios that you were starting with Manifest, I think, had a very similar result. So.
Yeah, we do see that, and I think the way to interpret that and translate it is that we do investing in high-quality companies, and the high-quality advantage is going to be most prominent during a bear market or a correction. So that really is the time when our approach to investing kind of kicks in and makes that difference. And I think that we see that played out in a lot of the portfolios and the clubs that we visit and all that kind of stuff. Anything else?
Mark, I know that one of the stocks, at least in our portfolio, is going to go private. How will we handle that in a tracking portfolio? Just close the position at that point?
Yeah, we'll take it out at whatever the purchase price is. And I know that Hogs, Zhongpin, already has an offer on the table at $13.50. And the price seems to be drifting towards that level right now, so that could happen at any time. And here's a good way to look at the question that Ken just asked. This is kind of our what have you done for me lately? And the reason I bring this up is, you saw that steadily improving performance on the previous slide, this zone right in here. And we're actually going to look at the transactions that have been in that zone, everything since April of this year. Every single transaction is listed here. The price at the time of the roundtable session, the price today, that's as of yesterday. So we can actually calculate a total return that does include dividends, because this is a dividend impacted price here. So it does include dividends, and we compare every result that we get, this 13.84 Southwest Airlines LOVE, versus the market at 0.5% since the time of that April meeting. So we have a relative return of, as it says there, 13.3%, 13.8 minus 0.5, and you can go all the way down the list. Obviously, the important thing are these huge stretches of green. Every one of these is outperforming the market since time of selection, all of these in this range too. So our best performing selections over the last several months have been Portfolio Recovery. I think that's one of Ann Manning's. Aflac, I think either Ken or Cy brought that either once or twice. And LKQ from Herb Lemcool recently. And then the weaker performing ones are also here too. It's not First Niagara. And Research in Motion we'll be talking about a little bit, but not too much weakness here on this display. So a lot of stocks that have done fairly well. Anytime you see these type of repeat selections, like here for Echo, here for Fossil, that's just simply the audience selections. Here's eGov. So the audience selection made that night makes it a duplicate entry. So you can see that in all three of those cases, the audience is actually doing pretty well too.
Landauer is also a audience selection.
Yeah,
they just didn't come up next to each other for some reason.
Yeah, I always put the audience one last so you can kind of see the doubling up. This is probably an audience selection here too. And again, all of those are doing pretty well, so the audience selections have actually thrived. Any questions or comments on any of that, Ken?
No, things are looking really well. I'm noticing that RIMM is no longer dramatically down in relative return. Mark, you might make that you might put lipstick on that pig no matter how it looks.
You know, if you wrestle with that pig long enough and have enough lipstick, you can work wonders. Apparently, you know. I won't even dredge up a hog. Oh man.
Mark, we're getting a question from Susan. She wants to know why there are 3 fossils. And actually, Susan, what happened that evening was Mark chose fossil, I chose fossil, and then the audience chose fossil as well. That's why there's 3 of them from that particular evening back in June.
And we're really grateful when these are all positive over here when it comes to these 7.9s. Anytime we're going to triple up like that.
Ann is asking if she can have some of this raw data, and I would suggest that we're not going to try to make this available to everybody, but Ann, since you're one of our damsels, I think if you wrote Mark a special email and asked real nicely, I bet he'd be able to get you some of this data.
Absolutely. All right, so with that, let's go ahead and take a look at the portfolio. And what I'm going to do here is I'm going to approach it just as we always do. I took the entire tracking portfolio and sorted it by return forecast or projected annual return. So this column was sorted from highest to lowest. Obviously, the ones at the lowest end are the ones that we want to pay the most attention to. And this is the one that my friends really want to pick on tonight, so I prepared some comments for that one. But if we were going to think about closing out a position, and again, keep in mind our objective. Our objective is to outperform the market. The companies that are shown on this list are all with my par at 9%. The average stock right now tonight is 9%. We're basically showing a list of companies that we are forecasting to underperform the market. And our goal is to outperform the market. So obviously you don't want to get too carried away. All of these, in my opinion, and you guys jump in and correct me if you think it's wrong, but I basically throw a blanket over all these and say these are all still pretty close to the market in general. And the only reason I would ever go after any of one to sell any one of those would be if I really thought it was hugely non-core. In other words, a speculation or basically a trade. We're going to talk about a really non-core company here in a minute, this Research in Motion. It's become completely non-core. But again, we would look for any one of these, if it was heavily non-core, to be a candidate for selling or closing out the position.
Yeah, I think that's...
Go on, Si, go on.
Oh, okay. I was going to say, Mark, I think you probably handled it with your non-core distinction. As a matter of practice, I do tend to at least look at anything in my portfolio that is below my par. Rarely does it go beyond just a look, assuming the bottom line is sufficient, which in this portfolio's case it is. But the one qualification I might have, let's say somebody like a Costco that's running about 2 points behind the market. If that were, and this may be getting to a non-core, because it's likely a non-core holding that would be this circumstance. But for example, I remember my investment club a number of years ago purchased 3M at a very low PE, basically with the intent of riding the PE up and eventually selling it, a value play more so than a growth, because 3M at that time and even today is not a particularly fast-growing company, but it was particularly beaten up on a PE basis. So if I'm doing that and we have gotten the run-up in the stock through PE, there's really not that much left of our goal of doubling in 5 years, or the 15% or 5% above the market or whatever. If it's a PE expansion play, I might tend to be quicker to pull the trigger.
Yeah, I would agree with that too. And again, I would throw those type of value situations into a kind of a special class.
I think as well, Mark, that I might put a 0 on this potential challengers list that you've put in the bottom of the slide here, and step 0 might be to ask the question, are the fundamentals falling apart in any of these companies? Because even before I'm checking par values and everything, I'm trying to keep track of fundamentals. Now, granted, this is a huge portfolio to try to keep track of every single stock, but especially when I'm looking at stocks near the bottom, I'm always concerned about whether the fundamentals are going to be there. That's why I'm going to suggest tonight that we take a serious look at Lilly. I just want to direct your attention to the yield for Eli Lilly, and then kind of put that together with the potential annualized return, and you'll notice that basically we're saying that Lilly has very little actual stock appreciation left in it. Most of that appreciation, that par value, is coming from its yield. And I'd like to look at the forecasts and the graphs for Lilly, because I think we might be looking at a company, and granted, I haven't studied Lilly to any great extent, but on face value, it looks like some of the wheels are coming off the horse here. Well, that's certainly a terrible analogy, isn't it? Wheels are
long
coming off the car, okay?
the wheels off the horse, just throw a pig in there and we'll be all set with our analogies.
The whole thing's set then, okay.
And then as we discussed also, on the opposite side of that, we have a situation here where $1,000 invested in TJX has become $2,000, and I think most of us in the room realize that anytime we buy into a company like TJX, you know, we believe they are susceptible to fad and herd behavior, and maybe we should celebrate success and take a look at TJX. So that's why they ended up on the pile. So we will be taking a closer look here for the next few minutes at Lilly, TJX, and I will throw research in motion, give people something to chew on, and hope that I can convince you that maybe we should hang on a little bit. So let me start that discussion, and you guys jump in whenever I say something completely insane. Here's a look at our situation with research in motion. It was purchased as what I would deem to be a special situation back in, the first time was back in May of 2011. I didn't believe the company was in as much desperate situation as it is, or as it proved to be. And it was kind of back in this point in time here where we had possibly oversold condition, and anytime you get one of these crossovers, that should be a danger Will Robinson moment. Definitely is a point where this falling knife thing comes into play. You want to be very careful with this type of condition for any company, and I wasn't, and you can see that we paid $43 back in that time frame, and it did drop as low as, I believe, $6 a little over a month ago. It has recovered back to $12, or $11.98 yesterday, as Ken and I were talking. So that makes this second position where we went in basically doubling down on a situation that we thought maybe had stabilized a little bit. That would have been back in the April situation, somewhere back in this time frame where we thought maybe it was beginning to bottom out a little bit. It has not proved to be that at this point in time. It continued to sink, although it's a little bit of recovery here lately. One of the things I do like to point out, though, is we really do have a situation here where a lot of damage was done very quickly to the company. Could have made a case for bailing out of this thing somewhere on the way down, and those type of protections can be in place, but we don't have that here. But I do argue for, in a situation like this, once the damage has been done to such a sufficient or dastardly degree, that your patience has to kick in. Unless you're doing some type of a tax-related loss selling, harvesting of a tax loss, I do want to point out, you know, there was talk of selling this thing a month ago, and I suggested, you know, how much lower can this go? Of course I know the answer is zero to that question, but I will point out that, you know, we were down quite a bit in this, and that it gained 58% over the last month. And now the question could be, is this an opportunity up here, potentially overbought, to finally bail out and at least rescue one of these positions? Could be. I mean, this is definitely a overbought situation where you could at least lick your wounds a little bit, but I continue to point out that this company has no debt, and the book value continues to be in the $20 range. If they do manage to stop the bleeding, clearly not an end of the world situation to me, and it's basically at 50% of book value. As far as the rest of the situation goes, and then I'll let you guys take shots at it, I kind of compare this to Garmin a few years ago. Remember when people decided that the Garmin was a business model that was in severe jeopardy? And I look at this situation. This is taking one of our equity analysis guides from our My Studies part of the website. Ken's going to visit that later. And I just want to ask a fairly simple question, because if you go back to the slide here, you see some really ugly stuff here, especially that return of minus 7%. My experience as an investor over the years has been that when you get into a situation like this, the rhinos are pretty reliable when it comes to overreacting. And what I see happening here with this company is, again, they're trying to retool it. They're trying to come out of it with some value. And what I see, if you take a look at, this is for research in motion, you know, their track record on margins was 30s, 20s, you know, obviously declining a little bit until recently. And now they've hit this no man's land of almost across the board restructuring and reorganization. And I just got to wonder, is that maybe a little bit pessimistic? Obviously, it can stay at zero and get really ugly. And just to demonstrate the sensitivity, I took the numbers for Research in Motion. It's basically a $10 billion company that's basically going to flatline for a while, according to the experts. But what if you simply use a 6% net margin? Again, keep these numbers here in mind. If they could basically find a piece of the business to operate at 6 instead of this 2.7, the sensitivity of just doing that gives you this situation down here, a return of 8% versus that minus 7% that you see on our current summary. So, I mean, that's how big of a difference. This is a massive difference if the current management of the company is able to restore anything. Like I said, the damage is done. If we can hang on to it and have it recover anywhere back towards that book value level, again, we don't have tax losses to harvest. But if it were in my own portfolio at this point and I didn't need the tax loss, I wouldn't sell it, just based on this situation that you see right here.
Well, Mark, Malcolm has a comment for you that that's the longest obituary he's ever heard.
Excellent. So it's up to the three of us. Hugh's not here, so I guess we'll do a three-way vote. Again, here's our two positions, and I assume both of them would be on the table for selling. What say ye?
Well, Mark, we're getting a comment from Ed who says that RIMM just announced third quarter better than expected results. Analysts expect that the new BlackBerry will be a hit. Is that brand new news? I don't follow the stock, so I'm not certain.
I think that is relatively new news, and it probably accounts for some of what you're seeing there on the right-hand side. I mean, companies don't gain 58% for nothing. So it's either short covering or some good news. I have not dug in to see that. So thank you, Ed. You can join me on the let's hang on. Let's hang on with white knuckles for a while.
We also have a comment from Frank. He says that he compares RIMM to WordPerfect, and once users left it for Word, they never looked back.
That's certainly a conceivable possibility.
Didn't we talk about people that used what was that spreadsheet that so many people used and then suddenly went to Excel?
VisiCalc?
Yeah.
Oh, that was you, wasn't it, Mark?
Well, see, I'm living proof that there are dinosaurs out there, living dinosaurs who will use things far past their theoretical utility.
Was it VisiCalc or 123 you used, Mark?
Oh, I have them both. I still use Lotus. I don't know.
Okay,
my appeal would be to keep it and let it run, because we don't need it for the portfolio.
Although
right,
I do.
We've heard. Mark, Cy, where do you come from? You want to keep it in, or you want to freeze those positions?
I do not disagree with Mark's view. On the other hand, I also think I tend to agree with the audience observations as well, and probably the word and WordPerfect analogy may be somewhat apt in that RIMM was very much of a leader in what kind of the beginning of what we now call smartphones, and the beginner in emailing, and was very much of a business user's phone, and it's very much lost that niche and been bypassed, and I'm not sure that it can reinvent itself and jump into the current smartphone market, which is the iPhone, that the Android system phones, particularly Samsung phones, have been very successful in getting in. So I kind of have a feeling that we may be seeing more of a dead pig bounce. And I have sold these sorts of situations sometimes, and sometimes been wrong. Starbucks was an example of one that I missed it just because the company was retooling, although they were.
Oh, I lost Cy. Can you hear me, Ken? Ken, are you there? Ken, are you there?
If they start selling more, then their margins may well go up. You're just trying to do mathematical demonstration, but that's kind of my point. Is your argument just saying, gee, we can play with the math numbers and make it look better, but is it really making sense from a business perspective? So I think a long way of saying I would probably echo the obituary, except I would say rest in peace.
Okay, Mark, I'm going to give you a little bit of positive feedback and then probably side with Cy. The positive feedback, I spent Thanksgiving with my sister's boyfriend, who's a vice president for BASF. He travels back and forth to Germany on a regular basis and carries a BlackBerry with him, and said that he wouldn't carry anything else because it's the only PDA that's secure enough for him to communicate secrets on. Whether that's actually true or not, I have no way of knowing, but the folks at BASF are convinced that the BlackBerry is a secure device where they can communicate industrial secrets back and forth to each other. Let me bring you up to date on the comments coming in our question box. Malcolm would like to know if anybody knows, are there any patent assets? Any knowledge about any patent assets, Mark?
I do know that there are many technologists who believe that there are some royalties or patent assets that they could sell off.
Okay. Dan is making the point that the latest rumor is that Apple is going to buy RIMM. Butch says that all this discussion brings to light the difficulty of sell decisions. Malcolm makes the point that Apple has $1.2 billion in cash and is battling Google right now, so that might make it RIMM a good potential acquisition. And Butch says, do you set a timeline and sell if progress is not made by the end of the timeline? Certainly there's the option to do that, but I think in this particular case I'm going to side with Cy and make the challenge successful and close out both positions in RIMM.
That was my heart breaking.
Well, we just gave you the perfect opportunity for an I told you so moment 4 months from now.
Well, we could have one here, but it's a decision that actually I think could go both ways, because as you saw in that previous slide, there's also a case to be made for, guys, we made 58% in the last month, so these numbers got dramatically better in the last month. So we'll just leave it at that, and I will close the discussion by saying that my wife, who works for Chrysler, has used a BlackBerry for several years, and over the last 2 weeks she's acquired an iPhone, and she's not going back. So there you go, one more piece of anecdotal evidence.
Okay.
All right, so with that, let's go ahead.
What's our next challenge, Mark?
Well, our next challenge will be, again, just kind of walk us through this one, Ken, a little bit. This is a success story. What you see here on the chart is the purchase of TJX back during September 2010. It has rocketed, more than doubled. This is the comparison using Finance Yahoo of the stock that's shown in blue versus the total stock market in red. That's BTI, that's the exchange traded fund for the total stock market. So Ken, go ahead and take a cyber bow on this one.
Well, thank you. My instincts say that that I should be sticking with my original philosophy, which is if our numbers for the total portfolio are pretty decent, that I shouldn't be looking to sell these stocks until they reach money market returns, which we all know are practically zero right now. I did my own analysis a couple of times on TJX, and I get the same approximate numbers as Manifest gets, and they're in the same ballpark as the value line low projected return, this 5% coming off of value line right here. The only place that I differ a little bit from Mark is that I would in fact consider a company like TGX or or maybe another discount retailer of some sort, I would consider them core in my portfolio. And the reason that I would consider them core is that I think that there's a huge portion of the population that depends on stores like TJX or Dollar Tree or TJX's brands, which are Marshall and Home Alone, or Dollar General, or stores like that, to make a lot of their purchases. They don't buy at Kohl's or JCPenney or Macy's or Neiman Marcus. They go to the off-price places. So having a discounter in my portfolio as a core holding would not bother me in the least. At the same point, I understand about a tracking portfolio, and when you have great returns, sometimes you'd like to you know, ink them so that they're permanent. So I will submit TJX for a closing out of the position because of the fantastic returns since it was chosen.
How do you feel about it, Si?
I am probably echoing Ken almost completely, that it would be very much of a close call. I'm just looking at the price line here in the core non-core question, or the susceptibility to a downturn question. Notice you did get some significant lows there in the 2008-2009 time frame. So they did get beaten up a little bit in the Great Recession, but notice they kept their highs quite decent, and you know, were somewhat volatile in those years, but kept a pretty nice uptrend. All that said, I think that it probably is worth going ahead and closing it out, and you know, perhaps it'll take a dip in the next few months or year, and it would be attractive to get back into. So I would
agree.
vote to sustain it.
Yeah, I look at the company, much as Ken said, as being a potential core company, but I also think that there are shades of gray when it comes to core and non-core, and in this case, it's somewhere in between what would be a pure core company for me and an absolute non-core. So I would treat it, you know, that way. So I would be looking to sell something like this somewhere between money market and the market par of 9%. And in this case, I think it makes a lot of sense to exit position and celebrate victory and go on and get the next one. So we'll go ahead and do that. All right, let's go ahead and talk about one last one, and then we'll get into our stocks for tonight. The last one.
Mark, I want to make the point and remind our people in the audience that we're creating a tracking portfolio here, not an actual portfolio where we're looking to invest dollars. And a lot of the strategies that you're suggesting, putting it on a watch list or selling half, these kind of strategies just aren't part of the rules for creating the demonstration that we're doing right now. I think that maybe at some point we'll want to spend a little bit of time talking about the difference between a true portfolio and the tracking portfolio. We don't have that time tonight, but I do understand the comments that are coming from the folks in the audience, and we're not ignoring you. We're just trying to keep the segment moving so that we have enough time before our time is up tonight. Yeah,
but the concepts are not inconsistent, and
right.
What we're talking about, a company that, you know, our return forecast is, call it 4, 5, 6%. We're basically saying we're looking at a position in the tracking portfolio that we expect to underperform the market for the next extended period. So we could theoretically wait for it to be, you know, to get another burst of momentum. You can see it right here. Maybe another burst of momentum to drive it even lower. But again, we're talking about a position in the portfolio that is projected to underperform the market. So in that respect, it's not different. What is different is we're not really looking at the total portfolio quite as much as we would normally do. All right, so with that, let's go ahead and talk about the third position to be put under the microscope tonight, and that is Eli Lilly. This is one of our original selections from the first roundtable selection session, and you can see that it has outperformed the market fairly well, turning 19.9% annualized versus the market at about 11. So again, we're looking at a relative return of about +8, and it's been something of a war from one end to the other. You can see that the market has led for a while, and this is kind of a tug-of-war situation going on with Eli Lilly, including what was probably a pretty good opportunity when we talked about it last month to potentially exit Lilly. We did not take that opportunity. And you know, here's what the picture kind of looks like, and you guys can chime in on this one. Depending on how you form your expectations for the long term, again, Eli Lilly projected to basically flatline pretty much. How much will it flatline? Nobody knows. Value Line basically expects it to really flatline. If you took out these years back here, you would have a real flatline situation of approximately 0 to 1% growth. And probably the biggest kicker is that the forecasts for 2012 and 2013 show a significant downdraft. And I do know that they have some portfolio or drug development pipeline challenges, but also some fairly massive opportunities. So I guess I would nutshell this by basically saying, you know, the analysts expect earnings to be weak for this thing end of this year and end of next year. We believe that the stock price will follow that earnings graphic, and I think this is another one where you basically celebrate victory, move on, and watch for if there is any pipeline opportunities that give us an opportunity in the future. This is an extremely high-quality company. No
Mark,
question about it.
John makes the point that we should be a little bit concerned about high dividend payers, as the expectation is that the tax advantage for dividends is going to change for the next tax year. I know that that's anticipated happening. Nothing's for sure, of course, but that is anticipated. And that might be just another reason to, with this very high yield on Lilly at 5%, might be another reason to consider closing the position and celebrating the victory.
Yeah, many people believe that a big piece of that bump down is probably dividend taxation related, and I'm not going to get political, but it's a reality, and that could account for that dent in the stock price, or at least part of it. So I would cast one vote for celebrating victory, and
well, Mark, I'll join you in the celebration.
And I won't be the lone wolf in the wilderness. I'll join it as well. Just make one observation, not that I would necessarily make a sell decision based solely on it, but I took a look at the Chronicle overall manifest investing, and note that Lilly is currently selling at the lowest par over the last 5 years and very close to the lowest relative return, projected relative return to the market in the time. So again, just more corroboration that this seems to be an abnormally negative situation as opposed to just something that's fluctuating and that it'll bounce back.
Okay. If we get a little extra time, I'll go ahead. I made a note here. We'll check out the Chronicle and show people what we're talking about there.
Mark, we have Herb making the point that if this were a real-life situation, would you wait for the dividend to be paid before you close the position?
I would not. I would be of the basic theory that that type of action is priced into it in most cases. So I would not. I probably would not wait for it.
In other words, you would not expect the price to remain static as they paid the dividend. You'd expect the price of the stock to go down when the dividend was paid.
Right. You basically have a trough that comes along and accounts for the dividend for a while. So
okay.
It just in general, you know, I actually liked the idea last month, and I wish I'd have pursued it when you brought it up, Ken, to possibly exit the position a month ago, because it probably made even more sense a month ago. All right, let's go ahead. If there's no other questions, we do have about 20 minutes left, so let's go ahead and we'll try to keep these fairly brief so we'll have time for Q&A. Mine's pretty straightforward tonight. Let me talk a little bit about the candidates for where I find some ideas to study. Always, we start with the fundamentals of trying to find high return forecasts, high projected annual return, and high quality. And then secondly, we do like to find both of those characteristics in combination with positive sentiment and some potential momentum. And my wife and I did go to see the movie Lincoln this weekend. I would recommend it. Daniel Day-Lewis does knock it out of the park. He's certain to be nominated for an Oscar, if not win one. But I thought this quote was kind of appropriate to what's going on with the fiscal cliff right now, and just this notion of if you really want to get it right. I lost my pen. You know, good ideas flow better with beer, and as Herb Lemkel was sharing earlier, a little bit of wine's not a bad idea either. One tip that I would have for those of you that are not history buffs, that maybe if you are going to go to the movie, Tommy Lee Jones as Thaddeus Stevens and a few other people are just outstanding, and Seward, the guy who bought Alaska, they're all in there. And I would recommend that you go to Wikipedia or Google a couple places and study up on the debate that revolved around the 13th Amendment back in 1865, and just get to know some of the names, because they really do a great job of demonstrating. I'm going to write about this tomorrow. And if you think that the rancor and the fighting and stuff that's going on in Washington, D.C. right now is new and different, go to the movie, because you will not believe the level of discourse that has been on Capitol Hill previously. So with that, let me get into how I ended up with CVS Caremark. What I basically did is went into our database, looked for a bunch of companies that have higher return forecasts and also have some pretty good technical characteristics. And the reason that the beer thing tied in so well is my number one candidate, looking at all of the aspects of things, was this company with the ticker symbol TAP, and that, of course, stands for Molson Coors. And certainly a decent little look. But you can see all of these companies with MyPar at 9. These are all in pretty good shape from top to bottom. The one that's color-coded differently is Mesa Labs, and that does not have a value line low total return forecast, so that's the projected annual return from Manifest. And then just kind of a cross-reference to not only the value line forecast you can see here from top to bottom. Notice that CVS is down here. It's one of the lower returns, but it's still pretty good. And I don't want to get too greedy, especially after getting my fingers burned with RIMM. And I also noticed that WAG made this list, Walgreens. So that's kind of compelling when you see the two of them show up on a list like this, along with some other community favorites like Resource Connections, Danaher, Intel. My pick from last month, Massimo, is right here. And then just for some comparison purposes, again, we bring this to the analysis of every single stock we look at Manifest. But what you see here is the comparison between the fair value at Standard & Poor's and Morningstar compared to the current price, so the price versus the fair value. So if the price was at the fair value, it would be P equals FV or 1, so this number would be 0. In other words, the stock would be perfectly priced at 0. In the opinion of Morningstar, they think Danaher is basically at fair value right now. So what we're basically looking for, the farther you go out in this direction, the more on sale a company is. In other words, Morningstar thinks that Research Connections is the most on sale, right up there with the beer company down here and Intel up at the top. Standard & Poor's, always a little slightly less conservative, happens to like Walgreens and, interestingly enough, CVS. The fact that Mesa Labs doesn't have any entries from S&P and Morningstar means that it's not covered. And that can be an area of tremendous opportunity also.
Mark, can I give you 36 seconds on Mesa Labs?
Go for it.
The stock committee in my investment club has just placed Mesa Labs as the one stock we'd like to own in the next 3 months. We'll be studying it intently I had planned on bringing it to the roundtable as soon as I have a little bit more.
Check, check.
That it has 5 or 6 main products, and they really don't relate to each other very well. Their products is actually in the medical field per se. So very, very interesting, beautiful lines, and extremely diversified, very, very small. Sounds like heaven to my investment club, and we're going to be trying to make a case for it in the next couple of months.
Well, it's one that I wouldn't be the least bit surprised to see it show up here, so it's one that we can take a closer look at for sure. Anyhow, these are some good candidates. I really kind of zeroed in on CVS because it is at the top of the list. Graphed at the bottom here, but it is at the top of the list. And here's a look at some of the key characteristics of the companies that made that final list. And again, I've been kind of paying a lot more attention to companies that are towards the middle, very much like we do at these sessions all the time. And you can see that both of these pharmacy companies ended up right there. So again, Walgreens compares pretty favorably. Ken, can you hear me okay?
Yes, I can.
Okay, I had a signal that I may have dropped out there for a second. Okay, so it actually stacks up pretty well on that list. Some pretty good candidates for more study. CVS is no surprise or no stranger to most of us in the room. We do hold shares of this company. We also hold shares of Walgreens in my family, so we're equal opportunity. Pretty good looking company. The reason these 3 years are scratched out is because that's pre-Caremark, so those are taken away and ignored. You can see that this company does pretty well during a recession, so those are the type of companies that are pretty nice to have in the portfolio for the next recession. Again, that kind of underscores the remarks that Cy made earlier about quality companies taking care of us when bad times come. You can see that a low teens, low total return forecast is here. It becomes pretty easy to believe that trend line somewhere in that 7, 8, 9% range on top line. And then we also noticed that since the Caremark acquisition or the merger, that the price bars have hugged the earnings line pretty closely, just slightly above it. So if that were to continue into the future, it would be pretty easy to believe this is the price range for the 3 to 5 year forecast from a value line. Pretty easy to believe this picture that you see here, that the price bars could end up in this zone when we get out in that period of time. So we're talking about a low teens potential return forecast. Pretty good stuff, pretty good company, and certainly an industry leader. One of the other things that we've been noticing as we update companies that manifest is that we've been seeing deterioration, both at the top line and at the bottom line when it comes to the longer term forecasts. And this company is an exception. We've actually seen a little bit of moderate strengthening, strengthening of fundamentals when it comes to CVS. And again, that may not seem like much, but most of the situations I'm looking at these days, these numbers are flipped around, and the earnings are actually slowly deteriorating instead of in improving forecasts at this time. So here's the look at CVS Caremark. Obviously an excellent quality company, decent projected return in the low teens. A 7.5% growth forecast is feasible based on the trend that we saw a few slides ago. Net margin somewhere in that 3.5 to 4 range seems to make an awful lot of sense. And again, a PE ratio going forward in the mid-teens, that's also a pretty nice PE, pretty achievable PE for a company with this high of a quality, and we end up with a decent projected return at the end of the day. So good stuff. Any comments or questions on any of that? I did avoid the beer question. Didn't talk too much about Colson Moores, but would encourage a study of it. Ken, do I still have you?
Yep, we're still here, Mark. Everything is clear right now.
Well, that's my selection for tonight. So again, I realize we already have Walgreen as one of our tracking positions, but no harm in adding CVS. The conditions seem to be okay. So with that, let's go ahead and hear about Vera Bradley.
Okay, this is a choice that I made last month. It's down a little tiny bit from last month, and I am going to double down for the moment. Mark, I'm going to take the screen here for a little bit. And what I'm showing you now, folks, is the home page for Manifest Investing. And I'm going to go to stocks real quick, and I'm going to put in VRA, which is Vera Bradley's ticker. And I get a very high-quality stock with a par that looks just at the very top of the sweet spot. It's just into the yellow. The top is 19.1, and this is 19.7. I'm looking at the quality characteristics, and I notice that Vera Bradley is scoring really well in 3 of the 4 pillars. Really high financial strength, 88th percentile, and it gets 25 points for industry net profit, industry sales growth, which means it's growing faster than the industry that it's in, much faster, and its net profit margin is also above the industry average. Here are the industry averages. You can compare the sales growth forecast, for example, to compare the 18.5 to the industry at 8.4, and compare the net profit margin for Vera Bradley at 12.6 to the industry at 6.6. So it looks like it's really worth the high quality rating. Caution, however, we only have a little bit of data on this company. It's only been public for a couple of years, so we're basing a lot of our projections on a relatively small amount of data. And as I study this company, I find that I'm not in complete agreement with the numbers that Mark is using on the expected income statement. So I want to show you a feature at Manifest, and the feature is My Studies. When I go around to clubs in my area, I find out that a lot of you with Manifest Investing subscriptions don't even know that you have a My Studies tab. So I'm going to click that tab. Notice I already have a study of Vera Bradley right here, so I'm going to show it. And basically what I've done now is anywhere where there's a green box, I can either update data that already is historical, or I can go in and change numbers. For example, I think Mark is projecting about 41 million shares, and I'm projecting a little bit lower at 40.5 million. I also am projecting a lower net margin and a lower PE forecast, but I'm still getting generally a very decent potential annualized return for Vera Bradley at 8.8. You saw that this was saved. When I leave the page, it's automatically saved, and then when I come back to it, I can show it again and update it, or I can delete it. Mark, I don't know why we're getting all these pop-ups coming to you. You'll have to, we'll talk about that later, I guess.
Yeah,
but we can also delete if we choose to delete the study. I thought it was interesting enough to show you. And then when it appears on my list of stock studies, I get the Manifest numbers in the top line, and I get the numbers that I've chosen in the bottom line right here. I did choose to move the margin down a little bit. The number of shares is not showing on this chart, but I did change that as well. And you can see the difference for the 1% that I end up with there. So I'm going to add another position in Vera Bradley tonight, and that should be enough on that stock. I hope most of you know what it does. It's a maker of handbags and women's accessories. There's actually some accessories for men as well, and it seems to be extremely popular throughout all age groups, from very young girls through high school and college, and all the way up to mature women such as my wife, who just is in love with her Vera Bradley stuff.
Let's see if we've got any quick questions here.
Well, Gene is asking, if the club owns Coach, why would one buy Vera? And remember, Gene, that we're creating a tracking portfolio looking to identify companies that are going to appreciate, looking to identify a list of companies where at least 60% or more of them appreciate, and looking for a total appreciation number, a relative return at 5% or better. So we're not exactly creating a portfolio like you would do for your personal life or in a club situation. Mark, does that handle that question pretty well, or would you like to add to that?
No, just keep in mind that what Ken is saying with the selection of Vera Bradley is he expects Vera Bradley to outperform the market, hopefully significantly, going forward. And that looks like that's the only question there, so let's go ahead and I'll switch back to me if that's okay with you, Ken.
Sure enough.
And by the way, that does give us the opportunity. First of all, when I saw this Vera Bradley picture, I thought that might be my daughter's office. She tends to be something of a bag lady, but I mean, they do have accessories for everything you can imagine, curling iron holders, all kinds of things. So you can, wow.
Well, Mark, we're not telling tales out of school, Mark, when we say that Mark and I traveled last weekend to Chicago to put out a presentation in Chicago, and while we were gone, my wife and my sister went shopping, and they went to the Vera Bradley store near us, and who did they find in that store but Mark's wife and Mark's daughter? So all four of them met at Vera Bradley last weekend while we were in Chicago.
He's not making it up, and my daughter is at fault for corrupting them all. So good stuff.
And it pays to listen to your spouses, as Peter Lynch said in his first book, and his investment in legs. And his wife brought home the new pantyhose and an egg.
That's right. One last point before we leave Vera Bradley. One of the things that we do at Manifest Investing that some of you scratch your heads over every once in a while, after quite a bit of research, we believe it's urgently important to think this way. And in this case, the estimates for 2012 and 2013, these points would not be showing up, at least within the trend, on a traditional stock selection guide. I contend that they help a lot with the analysis of this type of company, because you really have only, when it comes to historical data, that's all you got. And putting those there and taking a look at the trend that seems to be establishing gives you at least a little bit more information to base your decision on. Now, it doesn't mean those are right, but at least that is the information and the opinions that are in place right now. All right, so with that, let's go ahead and give Cy the floor. He wants to come back to another repeat selection that we made a month ago, Landauer.
All right, thank you, Mark. And yes, I'm going to echo Ken and repeat myself from last month with Landauer, which I think is now the fourth time it's been selected. I believe Mark was the first back earlier this year. And we'll just real briefly review what it does, but you can see the basics here, pretty decent on consistency. Notice prior to 2009, relative flat sales and earnings, and that will become relevant as I talk through it later on. The company has been working on restructuring itself and building on some of its strengths and trying to get ready to go for growth going forward. Also, just to put it in context when we're talking about company size, note that this company, from the Better Investing NAIC standard of annual sales, would be an extremely small company at $165 million in annual sales. But I think you'll see that by many other characteristics, both by how long it's been around as well as the way you can see here its historical growth, it's acting as a much larger company. But again, we'll talk a little bit about those things at the end. So let's move on with the next slide. Here again, just the history of Landauer and a little bit about what its numbers are currently. Notice it's been around since 1955 and is a global company. with over 500 employees, nearly 100,000 customers, and then just a few other financial things that you see. Next slide. Again, I mentioned that it's global, and you can see that it's primarily a North American company, but also has some European and some Eastern, far Eastern, primarily Japan in there as well, and that's that international component I think is increasing. Right. Next. Here is my eagle on Landauer. Ken showed you where it came from, the My Studies tab at Better Investing, and it's the same judgments that I had last month: 8% sales growth, net margin roughly in line with what it's been the last few years, a little above the trailing 12 months that you can see. The graph shows you the historical, and of course the 15.2 in the first column is the trailing 12 months, or really the current to date net margin. Forecast of 22 PE, which again is about in line with where it is right now, leads to a little bit lower than the manifest projected return, which I think is about 21%, but still a very decent annual return at 17%. Next slide. Here's what I wanted to spend most of the time talking about, since it is a repeat selection. Touched on some of these things last month, but not as directly. And Mark and I were talking earlier today about George Nicholson's dog and pony show question. Whenever he's had a company presented, talks about, what's your biggest threat? What is your biggest potential hurdle? So I asked, what's the biggest threat to Landauer's success or Landauer's potential? And of course it could be growth, could be margins, could be competition, those sorts of things. I think in Landauer's case, growth is a challenge. That's why I pointed out the relative flatness of the growth prior to 2009. The core business, which was Landauer's sole business up until 2010, was radiation monitoring, predominantly occupational radiation monitoring in places where employees could be exposed to radiation, nuclear power plants, also in the health industry, MRIs and other radiological equipment, but not the patient's exposure, it's the employee exposure that they have monitored. And that business is a pretty stable business, but it's also largely a mature business, not a whole lot of growth there. And Landauer is a very big fish in a relatively small sea. That's why I pointed out the annual sales being under 200 million, yet behaving much like a big company, because that market was just saturated, and while they were a leader, there wasn't a whole lot of growth there. On the other hand, we'll see how the company has addressed it on the next slide. Another potential problem, go back to the previous slide for just a second, Mark. Also, I know Value Line noted that, again, the core business could face a long-term decline as nuclear energy is phased out in Japan and some of the European companies. Of course, here I kind of chuckled when I saw Value Line talking about long-term, because here they really are talking long-term, because we're still talking 20 and 30 years out. But that again, is a trend that could impact their business. And again, the margins have been declining somewhat. So I think those are the two areas of challenge. Now we'll go to the next slide. Here are the three areas that Landauer practices in, and I don't know what happened to this slide, since it was just a screen capture off of theirs, but somehow in the translation from my computer to yours, Mark, it's covered up the two lower circles. The left-hand circle is radiation monitoring. That's the core business I was just talking about. And then the lower right-hand circle is medical physics, which is one of the areas that Landauer has moved into. And the medical physics are, you can see there, the imaging physics and therapy physics, and that's just x-rays as well would be an example of imaging physics. MRI is another one. The therapy physics would be radiation treatment of cancer would be one example of radiation. But that's an area that Landauer has moved into, seeking to cross-sell their radiation monitoring medical customers into also monitor or doing their medical physics. And then last year they purchased a company and got into the medical products business, which is the top circle that you see there, which is essentially supplies, consumable supplies relating to the therapy physics and the imaging physics. So that's how the company is addressing that first question. What is its problem with growth? They're seeking to grow by expanding into these related areas. And they see a potential market of 1.5 billion. You can see on this slide. So certainly a lot of potential growth there. That's how the company is addressing that. As far as the concern over margins, they've been declining somewhat, both because of some restructuring expense and acquisition expense, as well as the medical products and medical physics areas do appear to be somewhat lower margin than the radiation monitoring business was. But again, the margins now seem to be leveling out and perhaps turning upwards. So I think those are the two challenges, the growth as well as the margins, but the company is seeking to address both of those. And in fact, you can see, I believe on this slide, yes, you'll notice the second column, the text, where they're discussing operating income. This is from a third quarter slide, but they have spent a significant amount of money updating their IT platform, and that they expect will improve their margins going forward. But the main reason I wanted to point this slide out again, just showing how the company is addressing that growth problem. Notice the third quarter of 2011, there were just two segments to the business. If you go back to 2010, you would only see one, that being the orange segment. They added the medical physics in 2011. You can see that it's growing significantly faster than the core business of radiation measurement. And then, of course, they've added on top of that the medical products, which is the green. And you can see on the left-hand side the revenue impact, and on the right-hand side the operating income impact. And notice, again, the medical products has a nice chunk of margin in there. If you notice, you just compare those two bars, the revenues versus the operating income, that's a good high margin area, and is helping to bring their margins back up. So that is why I'm looking at Landauer this month, and talking a little bit, shooting down the potential arguments against it.
Well, I'll tell you, that's got a huge amount of opportunity for margin expansion going forward.
Absolutely.
All right, well, with that, Ken, if you're available and ready to poll the audience, the three companies that have been nominated tonight are shown in that upper block. This is from last month, just so you can see how the voting went last month.
Okay, Mark, if you just give me 1 second here to, I do this particular job once a month here, so I have to make sure I have it correctly here. And the poll is launched.
While everyone's voting, I'll protest that organizers and panelists can't vote, since I heard one of the prime candidates for the American League Most Valuable Player in baseball, when he was asked if he would vote for himself, he says, "How can you be confident if you don't vote for yourself?"
That's right.
Well,
we should get a vote.
We'll give each one of us one vote. We'll all vote for ourselves. So, okay.
My poll is actually showing Massimo, so people.
I'm awfully sorry.
You must have pulled the one from last month. That's all right.
That shouldn't be. I'm sorry.
That should be CBS.
Yeah, that should be CBS, and I did change it, but I evidently pulled up the wrong thing. I'm awfully sorry.
So if you want CBS, vote for Massimo.
If you want CBS, vote for Massimo. That'll help, okay?
We'll try to get a little more practice.
I don't know what happened here. It came up on the practice, okay?
It looked fine to me earlier.
I'm going to leave it open for just a couple more seconds. We have about 80% of you voting. All you have to do is take your mouse and click one of the circles, folks, and you'll be able to vote.
And I wasn't kidding. The audience has a relative return, lifetime relative return of about positive 8%. So 8 percentage points better than the market. Okay, well, I'm going to close this now. We have 88% voting, and it was a close race. And here's the results. 37% choosing Landauer, 39% choosing Vera Bradley, and 16% choosing either Massimo or CBS. This is a very scientific poll, Mark, okay? 9% choosing none. So let's add a second Vera Bradley position, just barely, but it beats out Landauer by, it looks like, 1 vote there, 2 votes. Well, I like all 3 of those tonight. I really think that all 3 of them show pretty good characteristics. Okay, and I have to hide this now so that you can continue now, Mark. Go on. Yeah, Dean Alden asked, isn't this last month's poll? Yeah, the picture that you see on your screen is from our archived PowerPoint, and it shows last month's results. So she was probably looking for CBS because I know she would vote with me. Yep. We'll fix that next time around, guys. Any other questions or comments? I'm showing us at about 9:42, so maybe we can take a question or two. We try to wrap these up by 9:45. See, what we need now is a write-in campaign for CBS that we should conduct.
Well, you just got a vote in the questions block, Mark, but I don't think it was quite enough to pull you up. So. Oh, yes, Mark was going to show us something he wrote down. I think that was the Chronicle that I talked about, Mark.
Right. Okay, which company were we looking at?
Lilly, I believe.
Okay, that's right. Would have been during
Mark, while you're pulling that up, Butch Lang has his hand raised. So, Butch, you're unmuted. Go ahead and speak.
Thank you. Do any of you know a source where one can look up dividend history for a company? In other words, when the company started to pay dividends, and then is there a source that shows that history? In other words, if they had a history of increasing dividends annually, for example, Coke, realize, as most of us do, that they've had a long dividend history. But for any company, Massimo, Landauer, any of these companies, some of those with shorter histories, you'll see it on Value Line. But is there a source out there where one can go and look up that kind of information?
I do think Finance Yahoo goes back quite a ways. That's one of the places I would turn to. Any other suggestions, guys?
Mark, I've used Finance Yahoo just there's a place where you can check to just see the dividends.
Right.
And then it does give you the entire history. So you can go back quite a few years in Finance Yahoo if you're looking for something like that.
Yeah, and I don't believe it's available online, and I'm trying to think what the publication is, but Standard & Poor's at least used to, and I believe still does, have they had a specific publication that was the dividend history, and of course the dividend achievers.
The tab on finance.yahoo is called Historical Prices. There's a tab down the left-hand side of the page, and you want the tab marked Historical Prices. But that's the only place that I know for certain that you can get at least the last 5 or 10 years.
And then if you're going into a company like Lilly, you can say dividends only. You can see I'm actually there's 30 years here. I'm not sure why that faulted, but that's where you would find it.
Mark, I have a little birdie asking me, Cy, is your birthday coming up in this week?
Yes, actually it is. Mark and I share a birth week as well as a birth year. Mine is this coming Sunday. So.
Well, Ann and the rest of the crew are wishing you both a very happy birthday. Okay?
Thank you all very much.
Yes, thank you.
You can imagine everybody singing happy birthday to you guys. Okay?
An internet birthday cake.
It's cyber, right? Okay.
Yeah, that's right. Well, here it is. If you click on Get Prices under that Yahoo tab for Lilly, you can see a pretty extensive history going back. And Cy, you wanted to mention that the Lilly projected return was actually lower than it's been in quite some time.
Yes.
And this is what he was talking about here. The price has actually rocketed up pretty much in the last several months, and the return forecast, without any strengthening of fundamentals, is as low as it's been in 4 to 5 years. So yeah, that does kind of underscore the decision that we made a little bit. Well, with that, Ken, I think you can go ahead and sign us off, I think.
Again, gentlemen, thank you so much, and thank you all for coming this evening.